72,000 American jobs vanished almost overnight. And here's the detail that should make you uneasy. Every single one disappeared after the president vowed they would return. Not before, after. I'm staring at the data as we speak, and I honestly had to verify it twice because it's that grim. Since April 2025, U.S. manufacturing employment has fallen every single month. Not flat, not slowing, falling, month after month after month. And this is where things take a serious turn. In April, the president stood in front of cameras and made a very specific claim. He said tariffs, huge taxes on imported goods, would bring factories and jobs flooding back to America. Those were his words, flooding back. But here's the problem. Reality moved in the opposite direction. The very tariffs meant to rescue American manufacturing are now crushing it. And this isn't some long-term decline spread over decades. This is immediate damage. In December alone, 8,000 manufacturing jobs disappeared in just 1 month. Before we go further, here's why this affects you, even if you've never worked in a factory. Because as I'm recording this, global investors are watching this collapse in real time, and they're making serious decisions about whether the United States still understands basic economic management. Japan is quietly unloading U.S. Treasury bonds. European pension funds are shifting money out of dollar-based assets. Companies that once planned to build factories in America are now pulling the plug. This isn't only about 72,000 lost jobs. It's about global confidence in America's ability to make rational economic choices. Let me explain how this actually unfolded, because the mechanics matter. When the government slapped a 25% tariff on imported steel, most people assumed foreign steel companies would pay the price. That's wrong. American companies importing steel pay that 25% increase. The tariff is a tax collected at the border, paid by U.S. businesses. The theory sounded simple. Make foreign steel more expensive. Push companies toward domestic suppliers. Domestic producers expand. Workers get hired. Clean and logical, right? Here's what gets ignored. American manufacturers don't just import finished goods. They import components, raw materials, machinery, everything. When every input suddenly costs 25% to 50% more because of tariffs, manufacturers face a brutal decision. Option 1. Absorb the cost and destroy your profit margins. Option 2. Raise prices and lose customers. Most companies chose option 1 at first. Reports show businesses absorbed nearly 80% of tariff costs throughout 2025. But that strategy has a limit. You can't absorb massive cost hikes forever. Eventually, something snaps, and the first thing to break is jobs. The Institute for Supply Management released a survey last November with anonymous responses from manufacturing executives. One transportation equipment executive wrote, word for word, "We're beginning to make permanent changes due to the tariff environment, including staff reductions." That's corporate language for long-term layoffs. A petroleum industry executive added, "Heading into 2026, we expect significant pressure on cash flow and employee headcount." The manufacturing employment index in that report fell to 44%. Anything under 50% means more firms are cutting jobs than hiring. That was the lowest reading since August. But here's what most coverage completely misses. This isn't just about lost jobs. It's about why the policy failed so predictably and what that says about America's institutional competence. Modern manufacturing depends on global supply chains. A car built in Michigan contains parts from dozens of countries, steel from South Korea, electronics from Taiwan, rubber from Thailand. That's not inefficiency, that's optimization. Tariffs don't erase these supply chains. They just make them more expensive. An automaker can't magically switch to American-made semiconductors overnight. Either the production doesn't exist at scale or it costs far more. The chips are still needed. They just cost 25% more. That extra cost doesn't disappear. First, it hits corporate profits. Then it gets passed to consumers through higher prices, to workers through layoffs, and to shareholders through lower returns. Analysts estimate these tariffs amount to a $1,300 tax increase per household in 2026. That's but $300 coming straight out of your pocket. This is what kept me awake last night. Small businesses are getting hit first. They don't have the scale to absorb higher costs. They can't force price increases on customers. Owners describe themselves as the canary in the coal mine. And here's what most people aren't ready for. Large retailers stockpiled inventory before tariffs kicked in. They bought massive quantities when prices were lower. That buffer is running out right now. early 2026. Once they reorder at post-tariff prices, consumers will feel it immediately. We're talking about an inflation wave about to slam into the economy. And yes, it gets worse. While U.S. manufacturing bleeds 72,000 jobs, other countries are gaining: Canada, Mexico, even China. Despite all the tough talk, here's what's really happening. Canada saw this coming early. When tariff threats emerged, Prime Minister Mark Carney stayed calm and strategic. Canada imposed targeted steel tariffs to shield its industry, but avoided a full-scale trade war. They negotiated, and now, while American factories lay off workers, Canadian manufacturing is branding itself as the stable, predictable alternative. Companies once planning U.S. expansion are now looking north. Internal documents show Volkswagen scrapped plans for a major U.S. factory entirely. The reason? The policy environment became too unstable and hostile to manufacturing investment. Think about that. A global automaker decided the U.S. was too risky. Meanwhile, European pension funds are quietly diversifying away from dollar assets. Japan has begun trimming its U.S. Treasury holdings. This isn't panic, it's slow, rational capital reallocation. And here's what the administration doesn't want discussed. If manufacturing policy can fail this dramatically, what else is broken? What other risks are being misjudged? Investors are asking that question right now. Tariff levels have risen to an average of 14%, the highest since 1946. These aren't minor tweaks. They're the most aggressive trade barriers in nearly 80 years, and the impact is worse than expected. Labor data shows manufacturing jobs began sliding in May and haven't stopped since, not once. Reports now confirm manufacturing lost 14,000 jobs in May and June alone. By August, another 22,000 were gone. September, more losses. October, more. November, more. December, 8,000 jobs erased in a single month. Overall, manufacturing employment is barely changed since January 2025, but sharply down since April, when tariffs were announced. Factory hiring has collapsed to its weakest pace since 2016. Worse than the pandemic, worse than the previous administration. And then this happened. The administration fired the head of the Bureau of Labor Statistics after the latest terrible numbers were released. Apparently, when the data looks bad, you fire the messenger. We're now learning tariff-affected industries have shed roughly 90,000 jobs since March. Manufacturing lost 41,000. Wholesale trade lost 34,000. Even sectors untouched by tariffs are cutting staff due to broader uncertainty. Economists warn this pattern typically appears only during recessions. But the deeper story is unfolding in Canada. Canadian manufacturing employs 1.7 million people and exported $356 billion CAD worth of goods to the U.S. last year, $257 billion USD. Vehicles and parts alone accounted for $45 billion. Canada initially felt pain too. Around 1,000 steel jobs were lost. Manufacturing dipped, but Canada adapted. They negotiated smarter trade terms. They protected workers without escalating conflict. Now, as U.S. policy breeds uncertainty, Canada is becoming the safer long-term bet for global investment. Mexico shows a similar trend. With far lower per capita income, manufacturing jobs there are prized. Tariff chaos in the U.S. is pushing investment south. The irony is brutal. American tariffs are raising costs for U.S. households while creating factory jobs elsewhere. Then came the EU deal, and honestly, reading the terms was shocking. In July 2025, President Trump and EU Commission President Ursula von der Leyen finalized a so-called historic agreement on a golf course in Scotland. The EU dropped tariffs on most U.S. industrial goods to zero. The U.S., meanwhile, tripled tariffs on EU exports to 15%. The EU also pledged $600 billion in U.S. investment and $750 billion in energy purchases. Across Europe, critics call the deal unbalanced. Some call it humiliating. EU officials admitted they had little leverage. Compare that with Canada. Canada didn't fold. They defended their interests while keeping trade relationships intact. Strategic counter-tariffs, open negotiation channels. As a result, Canadian manufacturers aren't facing an existential crisis the way U.S. firms are. China is watching all of this carefully. In October 2025, Trump met President Xi Jinping in South Korea and announced a tariff truce. The U.S. cut tariffs on Chinese goods by 10%, bringing the average rate to 47%. China agreed to delay export controls on rare earth minerals and buy more U.S. soybeans. Translation: China kept its leverage and gave up almost nothing. Rare earth control remains intact. manufacturing overcapacity is redirected to Europe and elsewhere, just not the US. China now accounts for 31% of global manufacturing output. The US sits at 17%, the EU below 13%. With weak domestic demand, China is exporting excess production globally. And with US tariffs making America less attractive, that production is going elsewhere. Canada, with stable policy, benefits. Here's the uncomfortable truth economists keep repeating. As countries develop, manufacturing employment naturally shrinks as a share of total jobs. This happens everywhere. Automation replaces labor. Remaining jobs demand higher skills. Past steel tariffs created maybe 1,000 jobs while destroying roughly 75,000 elsewhere, a 75-to-1 loss ratio. Even worse, tariffs may eventually boost low-tech manufacturing while shrinking high-value advanced manufacturing. The good jobs, the engineering, advanced tech roles, move to stable countries like Canada, and that brings us to the brain drain. Manufacturing today isn't assembly lines, it's AI, materials science, logistics, and engineering. When companies leave, they take talent with them. Several major tech firms are quietly expanding in Canada while scaling back US investment, not due to wages, but stability. Japan continues reducing US Treasury exposure. European funds are diversifying. This is the confidence crisis playing out slowly. With midterm elections approaching, the administration now owns 72,000 lost manufacturing jobs, 72,000 families affected. So what happens next? Unless tariffs are reversed, job losses continue into 2026. Costs remain high. Demand hasn't recovered. Companies will keep cutting labor. Politically, a full reversal would mean admitting failure. Unlikely. More likely, selective rollbacks framed as victories, cosmetic fixes. Meanwhile, the world moves on. Canada is positioning itself as North America's stable manufacturing hub. Consultants are now advising clients to consider Ontario or Quebec before Ohio or Michigan. Think about that. U.S. states losing investment to Canadian provinces. Canada offers predictable policy, skilled labor, trade access, tax incentives, and lower employer health care costs. U.S. firms face tariff costs, labor shortages, and policy whiplash. Recent data shows Canadian manufacturing employment stabilizing while U.S. employment continues to fall. This isn't just about jobs, it's about institutional credibility. When policy repeatedly produces the opposite result, global observers take note. Confidence erodes, and once lost, it's hard to rebuild. Manufacturing ecosystems take decades to create and moments to dismantle. Skilled workers leave. Supplier networks collapse. Innovation follows opportunity. The 72,000 lost jobs are only the beginning. The real story is the confidence collapse, and its long-term consequences may be permanent. I'm curious what you think. Does this change how you view the situation? Where do you see this heading next? Let me know in the comments. I read everyone.